Good afternoon, everyone. This is Robert Smith with Eldredge Clark. Also with me today is Taylor Stockemer. We're both here in our Little Rock office and appreciate you all joining us today. We've got some folks still rolling in, but got a good group to talk about our topic today, which is the Corporate Transparency Act. You may know something about it, may know a lot about it. It was passed a few years ago, but has had a pretty slow implementation, obviously up to this point, but is set to go into effect beginning January 1 of 2024. The slow rollout of it is just a recognition, really, of the massive change in the requirement on private companies primarily. I would say this will touch 99%, it seems like, of all private companies in the U.S. There are some exemptions from the requirement, obviously, but it is, we've had discussions internally and then with clients about getting ready for this change and just how we think about how private companies operate and then what events give rise to some sort of governmental reporting obligation. As we talk through it today, we'll point out areas that are still kind of unknown, and in the discussions we've had over the last few months with other firms around the country, I feel like everybody's kind of in the same boat. We know what the law is, we know what the regulations say, but we don't really know what it's going to look like once January 1 gets here and we start the true implementation process of making these reports and just dealing with the reality of this kind of new reporting structure. The purpose is to combat financial crime, and that's clear. I think everyone knows that. And this also, I guess, helps to align U.S. regulation of reporting beneficial ownership to what most other developed countries are doing. And so that's the intent of it here, is to fight financial crime, to make that type of information more readily available to law enforcement. The group or the division of the government that's tasked with this is under the Treasury Department. It's the Financial Crimes Enforcement Network, which I know most bankers are familiar with. So FinCEN is responsible for putting this into effect. If you've done any looking at all or kind of dug around FinCEN's website for beneficial ownership reporting, which we have a link to later on in the materials, it is up and running as far as providing reference material and some information certainly about the act and the regulations. It is not yet operational for accepting beneficial ownership reports. That's intended to go live on January 1st, but not yet something that's up and going. So what we'll look at today, Taylor, if you go to the next slide, just to kind of give you an overview of the act itself and what the rules say, a little bit of background on the timeline, but then just the nuts and bolts of it. When is the company required to report? When it can, whether or not it's exempt, just those sorts of things. When you report, how you report, and then why it all matters would be any penalties, criminal or civil, that may occur. So we'll talk through what we know about that at this point as well. There will be a lot of, like I said, a lot of unknowns still that hopefully will be kind of fleshed out in the next month or so. We'll likely come back and have maybe end of January, have another one of these just to update the kind of real world implementation that we're seeing, at least in those first few weeks of the month. But with that, I'll turn it over to Taylor.
Thanks, Robert. Appreciate you all attending here today and listening to us try and give you our knowledge on the Corporate Transparency Act. I'm just going to cover a little bit more in depth of what Robert just stated, but for those of you who don't know, the Corporate Transparency Act, the CTA is what we'll refer to it here, requires certain types of corporations, LLCs, and other entities created or registered in the U.S., we're going to call them a reporting company, to file with FinCEN. And what are you required to file? You're required to file your beneficial owners, which we'll describe later on in this presentation, and you're supposed to provide identifying information of those who form the entities, being company applicants and those involved in the company. Also, the CTA authorizes FinCEN to disclose such information provided under the regulations to authorize government authorities and financial institutions, most of them being banks. It all started in January 1 of 2021 when Congress enacted the Corporate Transparency Act as a part of the Anti-Money Laundering Act of 2020. The reasoning behind that was to better enable critical national security, intelligence, and law enforcement efforts to counter money laundering, financing of terrorism, and other illicit activity. A little bit more on the timeline. December 8 of 2021, FinCEN promulgated proposed regulations by means of notice of proposed rulemaking. That rolled down the road for a little bit until about September 29 of 2022, when they issued a final rule implementing beneficial ownership information and reporting requirements of the CTA. That rule goes into effect January 1, 2024. And a little tidbit here, December 31, 2024 is a compliance date for eligible reporting companies created prior to January 1. So a little bit different rules for entities created post January 1, 2024, as those who exist now currently and will exist or be created prior to that new rule date. Some of the literature that we've read describing the intensity of this act and the regulations is almost as if the CTA is a measure created to shoot a fly off a wall with a bazooka. Moving forward, FinCEN estimates that there will be at least 32 million entities required to submit beneficial ownership information reports on the effective date of the final rule. That is quite a large number. And then they expect an additional 5 million reporting companies created each year thereafter. On December 16 of last year, FinCEN proposed the beneficial ownership information access and safeguards and the use of FinCEN identifiers for entities rule, which is the proposed access rule, which laid out the protocols for accessing beneficial ownership database by law enforcement and by eligible financial institutions. In addition to all the rules that we've stated, there will be a third rule called the customer due diligence rule, which is the anti-money laundering rule that governs how financial institutions collect BOI from their legal entity customers. And the proposed access rule was created to provide access to BOI to authorized recipients while still maintaining, quote, highest levels of data protection and oversight, quote. That is a big issue that we've discussed amongst firms and even internally is a lot of the information that we'll get to that are required to be reported on the information and the BOI reports is highly confidential. Social security numbers, address, name, things of that nature, and safeguarding that information can be very costly if you don't have the right safeguards. So that's another issue. Who is required to report? The CTA broadly defines a reporting company as a corporation or an entity created by filing a document with a Secretary of State or similar office in any state or territory or with the federally recognized Indian tribe. Additionally, any corporation, LLC, or other entity that is formed under the laws of a foreign company and is registered to do business in any state or tribal jurisdiction is subject to the rule. Accordingly, the rules have gone and listed U.S. corporations, U.S. LLCs, other similar U.S. entities such as limited partnerships and business trusts or statutory trusts, non-U.S. corporations such as entities that are limited liability partnerships, and so forth. A trust will most often not qualify as a reporting company under the CTA and will have no obligation to report its beneficiaries, trusts, or compliance overseer, trust protectors to FinCEN. However, certain types of entities, including most trusts, generally are not created through the filing of a document with the Secretary of State or similar office, and therefore just don't qualify under the regulations. However, a trustee, beneficiaries, and possibly the compliance overseer of a trust or a trust protector may be considered a beneficial owner of a business with which a trust owns. The final rule sets out 23 types of entities that are exempt from the definition of a reporting company and therefore are not required to file reports. And you can see the exhaustive list or the non-exhaustive list of entities that are exempted. We've kind of discussed that the majority of companies and clients will hopefully fall within a large operating company exemption. As you can see described on the PowerPoint, the three key triggers of that are the company employs more than 20 full-time employees in the US, in the previous year filed US federal income tax returns demonstrating more than $5 million in gross receipts or sales in the aggregate, excluding gross receipts or sales from sources outside of the US. And three, has an operating presence at a physical office in the United States. That being said, the list above is not an exhaustive list, and there are some other exemptions that companies or clients may fall, but other than that, it's not too widespread. One note, a subsidiary exemption does not apply to subsidiaries of money services, businesses, pooled investment vehicles, or entities assisting a tax-exempt entity. You can see the subsidiary exemption below, but according to FinCEN, it limited the subsidiary exemption to wholly owned subsidiaries to prevent entities that are only partially owned by exempt entities from shielding all of their beneficial owners. What is required to report? Each reporting company is required to report the entity name, including all alternative names, doing business as names, trade names, and so forth. Its business street address, excluding a PO box, the jurisdiction of formation, and unique identification numbers, your TIN, your EIN, and what have you. Each reporting company shall also identify their beneficial owners and company applicants who are responsible for filing the entity's formation documents. So for reference, if I create a company for a client here, not only are the beneficial owners for that company required to be provided, but also my information as well. The information to be required to be reported is the full legal name of such individual, the date of birth, current residential address, or the business address for company applicants, a unique identifying number from an acceptable, unexpired identification document, such as a driver's license or a passport. FinCEN will issue a FinCEN identifier number upon request following the provision of the above information. So therefore, if I provide my information as a company applicant, I can request an identifier number from FinCEN, which then it will provide to me, almost acting as a tax ID number or a similar stamped number where I can update my information and provide it for future company applicant reports. The final rule also requires reporting companies to identify their beneficial owners, and for certain companies, the company applicants, including those who are directly responsible for filing that. Meaning, if I use a paralegal to file for an entity formation, not only is my information required, but also our paralegal. So sometimes the company applicant rule can reach a little far. And each report is required to specify the jurisdiction with which the acceptable identification document came. So that may be important when trying to file all of the client's driver's license. Who is a beneficial owner? There are a lot of gray areas in the determination of this, but the final rule defines a beneficial owner as any individual who directly or indirectly either exercises substantial control over a reporting company or who owns or controls at least 25% of the ownership interest of a reporting company. There's also a definition of who does not qualify as a beneficial owner, as you can read below, which includes some custodians, intermediaries, employees acting solely as employees and not as senior officers, and so on and so forth. Who exercises substantial control? Well, under the final rule, an individual exercises substantial control over a reporting company if the individual serves as a senior officer, which the rule defines a senior officer to include individuals holding a position or exercising the authority of a president, a C-level, general counsel, or any other officer performing a similar function, which there is a lot of gray area in that in today's business operations. Also, anyone who may have authority over the appointment or removal of a senior officer or the majority of a board of directors, or any individual who directs, determines, or has a substantial influence over important matters of a reporting company, including, for example, the ability to dissolve, merge, reorganize, or selection or termination of business lines or ventures, or the amendment of any governance documents. And lastly, an individual who has other form of substantial control over the reporting company. The last prong is a catch-all provision for control that is exercised in less conventional ways and for entities that are atypical governance structures. This provision is designed to capture anyone who can make any important decisions on behalf of an entity. Please note that FinCEN explained that the performance of ordinary arm's length advisory or third-party professional services to a reporting company, such as tax and legal professionals, would not provide an agent individual with power to direct or determine or have substantial influence. So an important little caveat there. What is required to be reported? Ownership interest, as defined under the final rule, any instrument, contract, arrangement, understanding, or mechanism used to establish ownership, such as equity, stock, capital, profits, interest. An individual may own or control ownership interests of a reporting company in a variety of ways, directly or indirectly, including through joint ownership, certain trust arrangements, or acting as an intermediary, custodian, or agent on behalf of another. Other individuals with authority to control or dispose of trust assets are considered to own or control the ownership interests in a reporting company that are held in trust. The final rule provides that convertible instruments, options, warrants, and other rights to purchase, sell, or subscribe to an ownership interest are included, regardless of whether they are characterized as debt or equity. Puts, calls, and other options to buy or sell ownership interests are also included in the definition of ownership interest, except to the extent created and held by a third party without the knowledge of the reporting company. Another important note, the final rule identifies a trustee as an individual who will be deemed to control trust assets for purpose of determining which individual owns or controls 25% of the ownership interests of a reporting company. In addition to trustees, the final rule specifies that other individuals with the authority to control or dispose of trust assets are considered to own or control ownership interests in a reporting company that are held in trust. The final rule identifies circumstances in which ownership interests held in trust will be considered as owned or controlled by a beneficiary. With one, if the beneficiary is the sole permissible recipient of income and principal in the trust, or if the beneficiary has the right to demand a distribution of or withdraw substantially all of the assets in the trust. In addition, trust assets will be considered as owned or controlled by a grantor or settlor who has the right to revoke the trust or withdraw its assets. Company applicants. The final rule requires new companies created or registered on or after the rule's effective date of January 1 to provide identifying information on the company applicants. Luckily, reporting companies created prior to January 1 of 2024 are not required to report their company applicants for many reasons. One being that they could no longer be clients or could be long gone and no one knows. If applicable, the reporting company must provide a business address for company applicants who create or registered companies in their course of their business. A residential address is required for beneficial owners. So that's a big key, that if you are acting on behalf as a company applicant, you are not required to provide your residential address. Robert, do you want to take it from here?
I will. I appreciate that. And just to touch on a couple of things that Taylor went through there, the determination that any company needs to make is whether or not they're if they are a reporting company, are they exempt? Do any of the exemptions apply? And then the second part is if they're not exempt, who are the beneficial owners? And as Taylor noted, there are really two tests you look at under the regulations. One is control and the other is ownership. And you could have, really you could have any number of beneficial owners of a reporting company. It's not limited to one individual or three individuals or anything like that. So I said when I kind of started this that the substantively these rules are not terribly complex, but there is a lot of unknown, as Taylor just noted too, in how how we expect the government would interpret some of these provisions when it comes to like the control issue that he just mentioned, which is they use the term substantial control to define what substantial control is, which makes it rather difficult to advise a client. But I would say those are the two things just to take away as far as what a company should be doing now. It's evaluating whether or not you're exempt, and if you're not exempt, then we need to evaluate who the beneficial owners are under the control and ownership test. So having covered who reports and what to report, on the next slide here, when to report, when does this actually go into effect? And as we've noted, it's coming January 1, 2024. As I mentioned earlier, the can had been kicked down the road several times, given the enormity of this kind of undertaking for businesses around the country. No one any longer believes that that's going to happen again. So January 1, 2024 is the effective date. It kind of rolls in a staged process. One is for existing entities, and then the other for entities created January 1, 2024 and going forward. From a reporting standpoint, in terms of the timeline for existing entities, as we've said, January 1, 2025 is the drop dead date, so to speak, by which companies have to report. The reporting opens January 1 of 2024, so there will be really a 12-month period in which a non-exempt reporting company could submit the report. I, like many of you, would expect that a year from now, there will be an absolute rush of companies that have not yet, millions of companies probably that have not yet filed, and they'll be rushing to do so by the end of the year, next year. So that's for existing companies. For any company, starting in January, when we form another LLC or corporation, the rule was tweaked here recently to allow 90 days during 2024. So if you set up a new company January 15th, you have 90 days from that date to make the initial filing. Once 2025 rolls around, that period is shortened to 30 days. So there will be a little bit of a tweak there. But bottom line, as far as when to report, there are really three things to know. One is you file an initial report within either within 2024, as I noted, for existing companies, or within that 90-day period. So that's an initial report filed for an entity. You then file a report if changes occur in the information that you previously submitted. And then the third type of filing would be, over on the next slide, Taylor. The third type of filing would be a corrected report. So if there's an inaccuracy in information that was previously reported. So as the first bullet point here shows you, within 30 days of any change in information, companies required to circle back and make an updated filing with FinCEN through the portal. You think about, you can easily think about situations how burdensome this is going to be. If you have an individual that's a beneficial owner and they change, they move and they get a new driver's license, well, technically they're 30 days to upload a photo of that ID to the FinCEN portal, or potentially face penalties, which we'll talk about in a little bit. Other situations which are pretty clear, if a new beneficial owner is added. So if whether that be a new senior officer is named, whether it be a new equity owner is added, or someone's bought out and that increases another party's ownership interest above 25%. You can think of some simple things that we run through, and I know you all see pretty frequently with customers those things happening, and now there's an additional filing that's required, and it does seem a little overwhelming, not really knowing how it's going to play out in terms of implementing this thing. But just be aware that those kind of run-of-the-mill changes or events happening to a company now will require some sort of extra step and a filing and have a deadline associated with it. At the bottom of the slide there, I mentioned correcting a previously filed report. So if you've made a filing and there's some inaccuracy on it, there's a 30-day period from when you become aware of the inaccuracy. There is a safe harbor in the regulations that essentially provides that if a report is corrected within 90 days of its original filing, then there's a safe harbor from any type of penalty for that. But that, again, that's from 90 days from the original filing. So 6 months later, after a filing, you realize there's an inaccuracy, you're required to correct it within 30 days, but there's not a get out of jail free card there for that. So just something to be aware of. So on the next slide, how we report beneficial ownership. So the agency has created a form. There were a lot of different samples floating around and all that, but it's getting finalized now. These will be, as I mentioned, they'll be uploaded through an online portal. That is not live yet. It will go live January 1, so we don't really know what exactly it will look like, but it hopefully will be a streamlined process. Hopefully it won't be overloaded, the first week and crash or anything like that, but that remains to be seen. I think I mentioned there is a lot of good information on the FinCEN website, reference materials. There are frequently asked questions that are being updated periodically. And then there's a small business kind of user guide, which you can take a look at there, which has some good information as well. On the next slide, as this came together in terms of the statute was enacted in 2021, and then FinCEN's working on regulations for some time, there were an enormous number of comments back to those and thoughts, obviously, on this whole process. And a big issue was just confidentiality and the sensitivity of the type of information with passports and driver's licenses and all that would be uploaded. So we're working to ensure that those are protected. The act itself authorizes, as Taylor mentioned earlier, disclosure of information to effectively for crime fighting purposes to U.S. Government agencies and law enforcement officials, also to some foreign agencies, and then to banks and financial institutions for diligence purposes primarily. That does require the customer, the reporting company, to give consent, but it kind of remains to be seen how that will be used as well. So that's still another one of the unknowns, I guess, that will play out. We can say that the information is exempt from a FOIA request, so from a Freedom of Information Act request, it would not be accessible. And the next slide, dealing with what I mentioned with penalties for violations. So there are penalties, both civil and criminal, that are built into the regulation and the statute. And if you step back and look at it, so under the law, the obligation is with the reporting company. So it is the entity itself that is obligated to file the reports. But it's a little unclear when the regulation addresses penalties. It references that if a company or an individual willfully failed to provide the information, willfully provided incorrect information, then that party can be either civilly or criminally liable. It is a willfulness standard, and so in the regulation, and so that appears to require some sort of intentional misconduct, or you knowingly ignore the obligation. It's unclear if a company and its officers and so forth are aware of the CTA and just decide they're not going to file or upload information or whatever, whether that's a willful act, that they are intentionally not complying. So those sorts of things will be determined in the future. The certification, or there is a certification required will be in the beneficial ownership reporting form that is true, correct, and complete. So not surprising, but again, a little bit unknown there. If you look at the next slide, the amount of the penalties could be pretty steep. I mentioned they're both civil and criminal components to it. The civil penalty itself could be $500 a day, and could be pretty substantial as that racks up. the safe harbor is noted there in the second bullet point. And again, that has to be a correction of inaccurate information within 90 days of the original filing. So on the next slide. Yeah, so the act itself had a lot, or spent some time discussing clearly the intention that FinCEN would effectively partner with state agencies on the rollout of the CTA. That really, from what we've seen, the interaction between the federal government and state governments haven't been very fruitful up to this point, at least. They just have not received much traction. There are a handful of Secretary of State websites that I've visited in the past couple of months and noticed that they have a little information about CTA and maybe a link to the FinCEN website. So they're taking some steps there to put the information out there, and it's more of an awareness campaign than anything. I noted the Arkansas Secretary of State did not appear to have anything on its website as of yesterday related to the Corporate Transparency Act. Most of what I've read and what we've seen about it, the state governments are not receiving any funding directly for it, at least at this point, to help in the process. So understandably, they're not all that interested in lifting a finger to assist, which is understandable. The reality of the penalties I talked about a minute ago and who's responsible and what that could mean. FinCEN's a fairly small agency, relatively speaking, to others. So, how much a room or availability they really have to get out and enforce any violations of this remain to be seen. Funding of what it takes to go after folks for any violation or to report them to another law enforcement agency is just really unclear right now. And so we'll keep tabs on that and advise as it develops further. On the next slide, as far as just what we're advising folks to do at this point, as I mentioned earlier, it starts with the determination of whether or not a company is a non-exempt reporting company. I went through the 23 different types of exemptions that apply. Many of those are really easy to identify and determine whether or not a company or an entity would be exempt. But for most privately held, just business entities in whatever business, if it's not specifically exempt, which banks and bank holding companies are, but most of your customers likely would not be. And so determining that first, and then identifying on the substantial control and the ownership test who is a beneficial owner, and from that point, collecting their information, getting a photo of their driver's license, passport, just confirming addresses, just all that sort of information that have to be included in the report. It's better to go ahead and get out in front of that now. We're internally working through contacts with clients beginning early next year that we know will have 10 entities we need to file for, whatever it might be, but just kind of working through that process. So it's we expect that it will be this will take a lot of time for a lot of folks next year, and like I said earlier, I think a year from now it will be really, really busy because a lot of folks will just put it off until the end. Some other things on the next slide and the next couple of slides, just wanted to point out as we've kind of gone through this. And as I mentioned, the FinCEN, if you're dealing with this, I would encourage you to look at the website, read through the frequently asked questions, because they do give some good background on a few things. But again, just the reality of what this is going to mean for a lot of companies that may go through just day-to-day type issues that come up for any business. Reporting changes, as I mentioned earlier, 30 days from the date the change occurs. That could be a change in a corporate name, which is a real simple process that our folks go through all the time with clients. Now, again, you got 30 days to make a change in the filing. A beneficial owner being bought out or being added to a private company happens all the time. Now it requires a filing. An issue that will be potentially a big issue is you have a customer that borrows money, buys the stock in another company as a part of an M&A deal. Well, now if the target company they just purchased is not current or has some issue with its beneficial ownership reporting in the past, well, that's a liability issue for the buyer now. And so we've talked internally about preparing for the type of due diligence that would need to take place in a transaction like that. I think I mentioned earlier, a customer or client obtains a new driver's license and either changes the address, or if the identifying number changes, then there's a filing required within 30 days of that. The trade name, or DBA, the regulation doesn't specify that it has to be a registered trade name or a fictitious name. And we have, you see a lot of clients, a lot of businesses that just use kind of a DBA, but they've never actually formally registered it. Those kind of things are kind of unknown as far as what would happen there. The last point there is an exemption for an inactive entity, and it has 4 or 5 parameters have to meet or fall within. But not all, just what we think of like a shell company, just kind of sitting out there without any real activities, will fall under that. So it's something to watch out for as well. On the next slide, so Taylor talked about the senior officer. So the kind of the initial determination, I would say, of whether someone has substantial control, it's clear the regulation provides that if you are a quote senior officer, then you are in a position of control. And so for, as over the years, as companies have, or clients have more often used LLCs and some of those alternate type of entities away from a corporation, there, we have different, may have different titles for a lot of different positions. So just getting into that and determining truly who would be a senior officer, if it's, if they're not named president or CEO, there'll be some work to that. The members of the board, just to point out, they are not necessarily a beneficial owner. You have to look further in the types of authority they have, types of decision making, and that sort of thing. One of the things that Taylor had mentioned, that options so if a company has issued options, then on the ownership test, those are treated as ownership interests. What the rule says is that you treat options as having been exercised, and apparently regardless of any contingency. So sometimes, someone's granted options and they may vest over time for purposes of determining beneficial ownership. We just assume that they have been exercised. So a little bit of a odd interpretation there, depending on the circumstances. The other point I wanted to note, there is in the ownership test, one of the provisions looks at the total combined value of the ownership interest that a party owns. There's no definition of value or how you decide that. So whether a shareholder agreement that may have a formula would control versus just a fair market value determination is a little bit unclear there. On the next slide, just a note to one of the frequently asked questions that's in the list on the FinCEN website. So it points out that individuals may exercise control through a management company. And so that would be a situation where you have a third party contracted to provide management services, obviously, but then you potentially look to that company's really officers as potentially being beneficial owners of the reporting company. And so that just shows you how, you really have to get in and have a deep understanding of what the business operations of a customer or client look like to help determine whether or not you're reporting all of the beneficial owners for that company. Another, what I think will be a big issue potentially is shareholder agreements and operating agreements. So you think of a situation where you may have a 4-person LLC, and they're all party to an operating agreement, and one of them is estranged or they don't get along or whatever it might be. Well, that individual, assume they're all beneficial owners under the definition. Well, they all have to be included in the report. They all have to provide a picture, picture ID and that type of information. So what is a company to do if they can't get that information from someone? So we talked about internally, what do we need to include in shareholder agreements and operating agreements to either to somehow penalize someone or to expel them somehow, to remove them as a beneficial owner. So there's just some issues like that. The next point I mentioned earlier, just what types of diligence we need to think about in an acquisition transaction. And then lastly here, just wanted to point out that there's not an annual reporting, you don't report every year. You make an initial report, you update a report if you have a change, and then you correct if there's any other information that's inaccurate, you change that. And then I think the last slide just points, I wanted to note, parents and subsidiary companies. So even if they're in a consolidated group or kind of a control group, each one, unless you have the exemption that Taylor mentioned earlier, each one files its own report. And so for each one, we have to decide if it is exempt or not, and then who the beneficial owners are, and go through that process. One of the facts that I thought was interesting for the large operating company status, which, as Taylor mentioned, is 20 full-time employees. One of the facts here notes that you cannot consolidate employees across related companies. So there may be some planning on that, depending on if you try to get a parent entity exempt. You might move employees up to the parent level, to take advantage of that potentially. And then the last point, just wanted to note that the definition of reporting company refers, as Taylor mentioned, to a corporation, LLC, or an entity that is created by a filing. And states differ somewhat on this from one to the next. Limited partnerships in Arkansas are actually, under the statute, they are, quote, formed by the filing of a certificate of limited partnership, whereas a general partnership is just a contractual relationship, and then an LLP is really just a general partnership that you've made kind of an election for, so it's not separately filed. So the way I read it, an LLP, which you don't see a whole lot of, but an LLP would probably not be a reporting company. One other thing that we've talked to a lot of different firms about is making protective filings. I think you'll probably see a lot of those where there may be an iffy determination on an exemption or who the beneficial owner is or whatever, that parties, at least for now, just take the position that we're going to make a filing and maybe we didn't need to, but let's just get it out there to avoid any potential penalty. So I think that's the end of our slides and materials. Let's see. There are a couple of Q&As. Taylor, you want to take the first one is, what is the definition of an applicant? I think that the company applicant is the definition in the regulation, right?
Sure. And the company applicant is just that person who filed the beneficial ownership information report on behalf of the company. That could be somebody within the entity, or that could be your legal or tax representative. Could be me, could be a paralegal, could be anybody who files the beneficial ownership information report. If it's a beneficial owner themselves, then that person is the company applicant. This is more to capture the folks that are the third-party applicants as opposed to somebody internally. So, and the company applicants are required to provide substantially the same information, with the exception if it's in the ordinary course of their business to do so, to file the reports, then you can provide your business address. Meaning, if I file for every client that we have, I would provide the business address as opposed to my own personal residential address.
Gotcha. There's a question as follows: for the large company exemption, does the 5 million have to be on a consolidated return, or can entities with common control qualify? That exemption or the definition there references the reporting of 5 million in gross receipts or sales, I believe, and then it references that amount would have been reported. So it says on the entities, Form 1120 consolidated, Form 1120, and then or 1120S. So I think it could be on the. It specifically references a consolidated return, so I think that would be controlling there. We had a couple of questions about beneficial ownership information and what banks have previously been required to collect. and then in the database, when banks would have access to it. And I've not seen anything from a timing perspective. I mean, I expect it will be in January that banks would have access as it begins to populate. But I'll look for that further and advise on that.
So just a little tidbit on that. Financial institutions may have access to the BOSS system. The system itself to file the BOI reports is the FinCEN's Beneficial Ownership Secure System, BOSS. And so financial institutions will have access to some information on the BOSS system only to complete their customer due diligence. And one key note on that, the reporting company will need to consent to such financial institutions access to that reporting company's information. So that's a big key. Financial institutions do not get the same access to the database as the law enforcement agencies do, but they will have some.
All right. There's a question about whether we will handle this for active clients, existing clients. Yeah, I mean, we are planning to handle the filings, and it's kind of be honest with you, like I said earlier, I don't know what it looks like, a month from now. I don't know what it looks like 6 months from now. If this eventually, will it get to be something that companies, I expect companies that have a lot of entities affiliated with one another will probably end up doing it themselves. But yeah, our intention is to work with current clients going forward and try to figure it all out. There's a question if an owner owns less than 25% and does not have a management role, then is their information required? The beneficial ownership is determined either by having substantial control or owning 25% or more of ownership interest. So if neither of those existed, then I would say that person is not a beneficial owner for purposes of the reporting requirement. That may be, I think that's all we have right now. But we really appreciate Bankers Association allowing us to put this on, and certainly appreciate all of you. I know we have relationships with many of you, and we certainly appreciate that, and hope you all have a Merry Christmas. If there's anything we can do, you have any questions or anything like that, just reach out to Taylor or myself. You can see our contact information on the screen. So we will sign off, and we appreciate you joining.